Hello, good morning. Tēnā tātou katoa no mai haere mai. Welcome to Outlook 2024, where the Financial Services Council kicks off an action-packed events calendar with a surprise and superstar lineup and unmissable content. Thank you for joining us. It really is a gorgeous day today in Tamaki Makaurau with the sun streaming in. I'll be your MC today. I'm Vanya Thomas from Guardian Trust. So 2024 represents a new year with a new government, regulatory change and economic challenge. This morning we'll open with a karakia and then you'll hear an inaugural keynote from Minister of Commerce and Consumer Affairs, the Honourable Andrew Bailey, followed by a fireside chat with Richard Clippen. Then Samantha Barrass, Chief Executive of the Financial Markets Authority, will give us some insights on the FMA's outlook for the year ahead, and we'll look at 2023 in review, the lessons learned and opportunities discovered. And Samantha's keynote will be followed by a Q&A session. And you'll also hear from leading Chief Economists, Sharon Zollner, Mark Lister, and Calvin Davidson, in a facilitated discussion with Mark Benisevic. So if you're just arriving to join a table of 10, the layout is on screen. That'll help you find your table, and there is also the open seating. Now, it's a fabulously packed agenda this morning, so we are hoping to finish at 9:45 a.m. And it's my pleasure to now invite Glenys Talavai, CEO Public Trust, to give an opening karakia.
Kia ora tātou te whānau o FSC Outlook 2024 I hui mai ne. Ko Glenys Talavai taku ingoa. Nō reira e te whānau, koutou katoa e aku hoa, tēnā koutou, kia ora hui mai tātou. At the beginning of a new year, as we come together to hear from our distinguished guests on policy, regulatory and economic factors impacting our industry and broader environment, let's create the space for our kōrero by joining together for a karakia. Ngā mihi o te rake, te whānau e hui ne. Kia tau te rangimari e. Kia whakatapua tātou mea me nā mea. E whakapono ana tātou, humie, hui tai ki e.
Ngā mihi nui, and thank you, Glenys. Well, what a fantastic turnout today across the industry. We have insurance, investments, KiwiSaver providers, supervisors, trustees, regulators, MB, and a big welcome also to the Fourth Estate. As usual, we have a number of leading journalists in the room. The session is being recorded and we are on the public record. And now to the program. In a moment, Rob Flanagan, Chair of the Financial Services Council, will take the stage to officially launch Outlook 2024, and then Richard Clippen, Chief Executive of the FSC, will provide some opening remarks. Welcome, Rob.
Tēnā koutou kata. On behalf of the FSC Board, we welcome you here today for Outlook 24. Obviously, there must be some interest in it because this is a sellout crowd, and really appreciate that. I'd like to sort of just make a comment. Minister Bailey, for some period, has been listening and talking to the industry, and at the conference last year, it was pretty clear to us that he actually was starting to understand some of the frustrations, etc., that we have as an industry. Now that he's Minister of Commerce, I know he's reached out again directly to a lot of chief executives and senior managers and sort of closed sessions to get intimate interaction of actually the frustrations of what it's like to be a chief executive at the cold front dealing with all the issues that are thrown at us by government bodies. And I think it's the first time that I'm aware that has actually really happened, and I think there's been a lot of meaningful views expressed both ways. And I think we're going to hear a lot of what's, in Andrew's talk, what's been formulated through those conversations. I'd like to just give a message really to the Minister and to the senior officials of the FMA, Reserve Bank and other regulatory bodies, that these sort of dialogues should continue going forward. It is so important to understand the frustrations that senior managers are having in their day-to-day jobs. It's not about the content necessary, it's about the implementation of a lot of these things. And the frustrations through over-regulation, misalignment of regulators is a real, I was going to be rude there for a minute, but it's just such a pain and it's so costly. So please, regulators, please take that on board. So thank you very much for being here today, and I'll pass over to Richard.
Kia ora everybody, and thank you, Rob. Vanya, thank you. Such an amazing, safe pair of hands to wrangle a crowd this large, and to the crowd this large, thank you for joining us. It really is the start of the year. We do hope that you've come back from leave and holidays refreshed. 2024 is a pivotal year in our view for New Zealand, for the sector and for all of us, to really make a difference and to step up and not just respond to the agenda, but actually to help lead the agenda. I'll talk a bit more about that in a moment. But Outlook is about setting the agenda. It's about engaging with the leaders of our country, the leaders of our sector, and hearing what they have to say about where we're heading. And so in that context, today is very much a dialogue. This is very much about us as a collective leadership of our politicians, our regulators, the sector, the media, taking a step forward with what's on offer today. So there's going to be plenty of time for questions and plenty of time to engage. We've been talking in the FSC a lot about policy leadership. You know, how do we make sure that New Zealand heads in the right direction, not just from a financial services perspective, but certainly from the perspective of consumers. And many of you will be very aware that the FSC focus, in fact, our vision is to help New Zealanders with their financial confidence and well-being. And that's why conversations like today become important. That's why policy decisions are so important. And one of the things that we're going to start to lead the debate on is not policy for the next year or the next 12 months or the next 3 years, but for the next generation. You know, we know that successful policy doesn't bite immediately, that there needs to be bold and courageous decisions to set the scene for the generation to come. I've spoken previously on FSC platforms, having grown up in Australia and really entered the workforce when the superannuation system just started. My generation are the beneficiaries of decisions that were taken in the mid-80s. And so this policy leadership conversation is one that we want to help forge, we want to help lead, but we've got to kind of do it together. It is going to be around helping Kiwis with their financial confidence and well-being. It is going to be about helping them save appropriately for retirement. That steers right into the KiwiSaver debate. It is about helping people think about risk and risk management, and that steers right into the health and the life insurance conversation. And it is about getting advice and making sure that financial advice is a premier profession that people in New Zealand go, that's where I need to go when I need some guidance for making sure my financial affairs are in order. All of those things kind of come together and coalesce in a policy position that we all have a role to play. Collectively, the sector services millions of New Zealanders. The FSC tracks all this data. There are just over 3 million KiwiSaver providers. We're in touch with these people as a sector collectively every day. The life insurance sector, the health insurance sector, similarly. So we have a really powerful position, if you will. It's one of great honour, great privilege, but it comes with great responsibility, and that's something that we certainly take to heart. So if that's the scene for today, just a couple of welcomes and thank yous. To Rob's comments, Minister Bailey, a very warm welcome. You know, the FSC is apolitical. We do engage with politicians on all sides of the fence. You would have seen that at our conference. And we're really thankful for Minister Bailey's engagement when he was in opposition. He's now in the hot seat or the main seat, and we're really delighted to continue to work really effectively with him. So thank you for your engagement. To Sam Barrass and the whole team at the FMA, a huge big welcome. Your constructive engagement with the sector over a number of years has been really well appreciated. And I think to Rob's point, there's now an increased amount of activity to do together. But I do think that when regulators and sector, whilst we have different roles, actually have really strong dialogue together, 1 + 1 can equal 3 and 4 and so on. In the room, to the senior team at MB, ComCom and the Reserve Bank, also key partners in this process, so a very warm welcome to you folks. Delighted in the room to have so many of our sister associations. From the New Zealand Bankers Association, Roger is with us, from ICNZ, outgoing CEO, Tim, and Chris, incoming CEO from ICNZ, a big welcome. We have from Infins, Jim is with us. From the Women in Super team, Tracy and Prue and your committee are with us. And from the Financial Services Federation, Lynn and Hannah, a really warm welcome. Particular welcome because the associations in the New Zealand financial services landscape have a really important part to play to help guide and lead. And we're highly collaborative because we're pretty much coming from often the same perspective. So really delighted to have all of you in the room. I did want to pay particular welcome and thank you to the board of Financial Advice New Zealand. A big thank you to Tony, to Heather, to the whole FANS board, and of course a very warm Kiwi welcome to incoming CEO Nick Hakes. Like I say, collaboration is key, financial advice is key, and we look forward to really working closely with you. A couple more just to close it out. A huge big thank you to the Mint Ellison Rudd Watts team for their support for today. And in addition to Russell and his team at Quote Monster and Chatswood Consulting, big events like this only happen when organisations step up and help and people join. We have a number of large FAPs in the room, large and small FAPs. To the financial advice community in the room, a big welcome. And finally, to everyone in the room, members, delegates, members of the FSC. The FSC is 119 members large now. We have over 500 people sitting on our various committees. This event is curated by our Conference and Events Committee. If you want to get involved, if you want to step up, if you want to help shape and lead, the opportunity is totally there. So thank you for your amazing support. Today is 50% larger than the same show that we ran last year. So thank you for stepping up and on the very last day of January, joining us to, as Vanya said, such an amazing day out there. So if that's a little bit of the scene set, let me take the moment now to welcome our first speaker for the day, and we absolutely are in for a treat with such a stimulating program. I'm really delighted to welcome Minister Bailey, who's not only the Minister for Consumer Affairs and Commerce, but also for statistics and for small business and manufacturing. And I'm sure there are some themes, Minister, that kind of play together there. Just briefly about Minister Bailey, I won't go in this exhaustively, but he's got an epic and pretty fascinating background. He's a dad of 3 sons. He's an adventurer, a mountaineer, and he's done some epic outdoor adventures. The one that really touched a chord with me was in 2019, Andrew and his son Dan undertook a 500-kilometre camel ride through Jordan, retracing the steps of the route taken by T.E. Lawrence. I just happened to be listening to a history piece on the weekend, and it was about T.E. Lawrence. So when I read that, I went, the universe must be telling us something. He has a vast experience in business. He's chaired financial advisory groups, been in investment banking, really well qualified to talk to us today as the Minister of Commerce and Consumer Affairs. A very warm FSC welcome, Minister.
Maurina nā mihi nui ki runa e te tūmata tīmata o kororo ni me katoa. Me wihi kei te atua, hei manaki, ki tēnei reo korona, ko Andrew Bailey ahau, no Wanganui ahau. Good morning, everyone. It is fantastic to be with you this morning. Hey, my thanks first of all goes to the Financial Services Council and to Richard for inviting me. Also want to acknowledge Rob for that very kind introduction, and also for all your long 9 years of service. You have done a fantastic job. I also want to acknowledge Samantha Barrass from the FMA And probably slightly unusually, I want to acknowledge my team from MB who have been working with me over the past few months, who are with me here today. I just want to, first of all, say that the FSC has always been an important voice in terms of the financial services sector. I look forward to continuing to work with you all to help achieve your mission to improve the sector for all New Zealanders. And as Richard said, I've had reasonably long involvement in coming to many of the conferences over the years, and it's good. These are the type of opportunities I really value. In terms of economic priorities, our government is focused on getting our government and our economy back on track. Our 100-point plan on rebuilding the economy outlines 6 economic priorities to drive us towards an economic goal of improvement. These are eliminating wasteful spending, delivering tax relief, cutting red tape, building infrastructure for growth, boosting productivity, which particularly in areas like manufacturing and building construction is massive, and of course strengthening trade and investment. We've already made great progress. We've reenacted the 90-day trial periods, and we've dealt with the so-called fair pay agreements by repealing that bill. The Reserve Bank's dual mandate has been amended to focus only on maintaining price stability, i.e. lowering inflation, to name a few. There's still much to be done, however, including in the financial services sector. There are a number of reforms we will enact to make things easier for businesses, and we've already made a start on some of these. Today, I would like to outline some of the fundamental changes that relate to the financial services sector. But before doing so, it is useful to reflect on where we've come from. The seminal work that the Honourable Simon Power did in the 5th National Government that created the whole new framework for the sector was very important. Not only did it address poor conduct, but obviously led to the establishment of the FMA in 2011. I just ran into Simon last night in the airport, and said, Simon, I'm going to be talking about you today, because he did actually leave a legacy. Since then, under governments of both colours, or both sides of the House, there's been a series of legislative and regulatory changes aimed at enhancing conduct by financial institutions. Regrettably, this layering of regulation and legislation has led to the architecture governing the financial services sector losing some of its coherence, and has certainly led to a lack of clarity for many of you market participants. Many of the changes were well-intentioned, but today also, to some extent, are failing to deliver optimal outcomes for Kiwis and businesses. For instance, the increased complexity of is the Reserve Bank steadily involving itself in conduct issues, and the Commerce Commission having prime responsibility for monitoring conduct under the CCCFA. In some cases, certain entities are regulated by 3 different institutions. In essence, our Twin Peaks model has become increasingly complex, imposing costs on firms. Furthermore, many financial institutions now find themselves holding multiple licences from both the FMA and the Reserve Bank, adding to their operational burden. For example, a large diversified financial institution may have to apply up to 5 licences, and you all know them all. FAB, Richard talked about before, discretionary investment management licences, managed investment schemes, etc. There's a whole raft of them. And of course, the CoFI reforms, or as more appropriate referred to as the Financial Market Conduct of Institutional Amendment Act 2022, has exacerbated the situation by introducing yet another licence requirement, and is imposing substantial compliance costs on financial institutions to document their fair conduct programs. My view is that we are not sufficiently focused on taking a proportionate approach in developing fair conduct programs. Additionally, the Commerce Commission's role in monitoring and enforcing credit regulation relating to consumers through the CCCFA adds further complexity. I see value in consolidating responsibility for the financial markets conduct and the CCCFA under one single regulator. I consider the Twin Peaks regulatory framework, initially developed in Australia but now widely adopted overseas, as being appropriate. However, I am proposing to reinforce this model with better coordination and cooperation between regulators. Specifically, I envisage a model where the RBNZ serves as the prudential regulator and the FMA as the conduct regulator. I therefore propose that responsibility for monitoring the conduct in respect to the CCCFA be transferred from the Commerce Commission to the FMA. To address the duplication issue of licensing requirements between conduct and prudential regimes, I propose to consolidate and simplify existing conduct licensing requirements. The FMA could issue a single license covering conduct issues for financial institutions, while also clearly defining obligations within the Financial Markets Conduct Act, meaning easier reference for financial institutions as they grow and contract their businesses. Furthermore, I would like to remove duplication in areas such as initial fit and proper persons assessment required by both regulators and the need to report separately on cyber resilience. Turning to the CoFI regulations or requirements, I do not want to discard CoFI, but rather perform a targeted reform to ensure that the good conduct obligations are proportionate and fit for purpose, acknowledging the positive general framework. The two aspects include, first, reinforcing the principle that the responsibility for determining what is an appropriate fair conduct program for their specific business lies with the applicant. This means that liability lies with the management and the board to identify key risks and areas of concern and develop their fair conduct programs accordingly. In essence, this represents a move to a tailored and proportionate approach. And secondly, I'll be requesting that the FMA issue clear guidance for smaller institutions to meet minimum requirements of conduct. To put this second aspect in context, I believe it is essential all financial institutions have in place fair conduct programs that cover the following aspects of their businesses. The first one is, how do you engage appropriately with your clients and your customers? Secondly, how do you develop new policies and products to be fit for purpose and meet regulatory requirements? Thirdly, need to establish transparent fee structures and charging arrangements, particularly or especially if you have intermediaries. And the fourth one is the development of an adequate complaints process. Those are four vital elements. Whilst a fair conduct program might look different for a credit union with 200 customers compared to a bank with 2 million customers, the importance of fair treatment remains the same. Let me be clear, these changes are not about lessening requirements for appropriate conduct. It's about ensuring that financial institutions, you, have guidance from the FMA and take responsibility to meet your obligations more effectively without compromising on conduct standards. I know Sam will have more to say on the role of the FMA in ensuring CoFI applications meet minimum standards and the issue of responsibility of financial institutions to determine what is the appropriate fair conduct program to be put in place. I realise many of you have already begun preparing fair conduct programs for the introduction for the regime by 31st of March 2025. You need to continue to do so. But I do intend to ensure that appropriate timelines and transitional arrangements are in place to avoid any issues of uncertainty, which will include grandfathering of all CoFI licences into a single conduct licence in time. I hope this provides you with some clarity and clear sense of direction of my intended reforms. I aim to make it easier for businesses to operate and intend to move quickly to address these issues. Another of the changes we will be making is to the Credit Contracts and Consumer Finance Act, or CCCFA. This comes as a particular priority with its inclusion in our coalition agreement with ACT, which, to quote, states, "We will rewrite the CCCFA to protect vulnerable consumers without unnecessarily limiting access to credit." Changes that have been made since 2019 onwards have led to processing times for lending applications increasing significantly across all loan types. I've heard from banks that an estimated 6 to 7% of applicants who would have otherwise qualified for a mortgage have had to be turned down. Change is needed to address this. In my view, it is the detailed regulations and the strong liability regime that need to be reformed. Together, these two things have led to three things. First, led to an overly risk-averse lending decisions. Secondly, created unnecessary compliance costs. And thirdly, and most importantly, reduced access to credit for consumers. The intent, as with CoFI, was not to undermine good conduct requirements, especially for high-cost lenders who can prey on our most vulnerable Kiwis. However, the changes have unfortunately led to a significant decline in both traditional and short-term lending. The result has seen many vulnerable borrowers having to turn to alternative, unregulated, high-cost sources, the very people the changes were seeking to protect them from. We aim to subject high-cost lenders to adequate regulation surrounding lending practices. I'm proposing to reform consumer credit legislation to address this, and I propose doing a two-stage approach. First stage, I'm going to remove the prescriptive affordability requirements for lower risk lending. I expect to do this soon as a matter of priority. At a second stage, I will undertake a more substantive review of the CCCFA. This will include reviewing the penalty and disclosure regime and its relationship with CoFI. The specific changes will be announced in the coming months. Another reform that I'd like to talk about today is the reform of the Companies Act. The Companies Act is an important piece of legislation. It provides the operating framework for all New Zealand companies, including those in the financial services sector. It's been an important part of the corporate landscape of New Zealand for decades. But it's now 30 years old. I think aspects of it are out of date and can be improved. To this end, I'm considering how it might be improved and how these changes might be progressed. This is an important medium-term project, but rest assured I will provide more details on this further down the track. But in essence, what we want to do is to simplify, modernise and digitise the Companies Act. The reforms I've spoken about today, namely restructuring the Twin Peaks regulatory framework, simplifying licence obligations, CoFI, CCCFA and the Companies Act, are my current priorities. But looking ahead, I see a need to address many other issues in the sector as well. I agree with the Council that there are longer-term issues in New Zealand. New Zealanders are not as financially illiterate as we want them to be. New Zealanders aren't always prepared for retirement, and some New Zealanders struggle to access affordable healthcare. I expect the reforms mentioned today will make some progress towards addressing these longer-term issues. Reducing burdens on all businesses will make it easier for customers to engage with and receive financial advice from financial services, for one. But there is still much to be done. Looking further into the future, I'm interested in exploring changes in our capital market settings to help New Zealand businesses and investors thrive. I'm also interested in changing KiwiSaver settings to help New Zealanders save more for their retirement. I look forward to discussing this more with you in due course. But I'd also like to take a look at the work on insurance contract law so that insurers and policyholders have better certainty about the deals they're striking. As with the capital markets and KiwiSaver work, this is a future work stream, and more information on this will come at a later date. In closing, I would like to reiterate that the government is committed to improving outcomes for all New Zealanders. We need a thriving financial services sector to do that. That's because for consumers to get the help they need, businesses need to be able to work effectively. I'm confident that the reforms I've announced today will move us closer to that vision, and I believe New Zealanders will be better off because of them. The financial services sector is an important part to play in getting our economy back on track. I'm confident that you will all continue to play your part and that we will continue to have a constructive discussion between government and the industry. Thank you all again for having me today. I look forward to speaking to you more, and today is the first of many conversations that we will continue to have. Tēnā koutou, tēnā koutou, tēnā koutou katoa. Thank you.
Minister, thank you for that. That's a lot of change. That's pretty revolutionary view of where the sector should be heading.
Yeah, I just think it's very timely. Everyone's, as I said, everyone's tried to do the right thing, but I just think that we've got to stop and pause and look and make sure that everything is coherent. And I've seen it, and I've also in discussions with people like you in the group. It's just timely that we actually have a proper review of where we are, make sure the legislation's working well together, and also updating things like the Companies Act, which now obviously need to be done properly.
Has that been a consistent theme that you've heard on your travels around complexity is stifling things, so let's try and simplify?
Yeah, certainly it has. And of course, I've spoken many times at these conferences before, and even over the last couple of years, I've been talking about looking at the architecture of the legislation that relates to the financial services sector. So what I'm doing is bringing that to life. The biggest issue, I've got so much I like to do, and working with MB, we're just trying to do it in sort of half-year blocks. And, obviously I've got more stuff I want to do. I can keep going for years. But we just got to try and finish small bits, get it done, move on, give you all certainty. Because really, at the end of my tenure of this role, whenever that might be, but I want to make sure that we put the sector back on a footing where you feel like you can go into business. You do want to be part of this sector. And as one of the big things I worry about is this inability now, or difficulty of actually getting good advice from people, because we're so constrained about wanting to offer or proffer advice. That's the wrong thing. New Zealanders need access to great financial advice, and we just got to make sure the settings are there so people have the courage and the ability to do that. Just coming back to a point you raised earlier, which is, you were in opposition developing plans. You come into the role. How do you determine what's your order of priority? What are the most important things to fix? How did you kind of work through that? Well, obviously we had the coalition agreement, so the two things, CCCFA and CoFI, I must deal with quickly, and I'm obviously working at speed on those. But that architecture, I think, is a big strategic stuff, and the earlier I start that, the better. And the Companies Act, I've always been very interested, but next time I come and talk to you, I'll talk about what we can do around the capital markets, because one of the big issues I've got, if you put on my other portfolio hats, is New Zealand businesses need access to capital and to debt, and I just want to make sure that settings, so all we've done, and I sat down with the MB, we've got limited resources, we're just going to do it in little chunks. I'm looking at Andy and Paul down there. We're just agreeing to do it in small chunks, they're quite significant chunks, but I want to deliver stuff, and then we'll move on to the next stuff and not try to do too much.
There's lots of fantastic questions coming through, which I will head to in a moment. Minister, prior to the election, there were a number of announcements made in relation to KiwiSaver, to buy flocks of sheep, to pay for rental bonds. There are a range of those kind of ideas. Where are those up to?
I'm not actively considering those at the moment. When I come back to you about KiwiSaver, actually there's a wider argument, and I talked about changing some of the settings. Some of those issues that we were raised, obviously we're now in a coalition agreement, and whether they all progress will be a matter of whether the ministers want to come and have a chat to me about those specific initiatives. But the KiwiSaver debate obviously is an issue about Kiwis not saving enough for retirement. I think it's the biggest issue, apart from the divisiveness of our society. But the big financial risk for New Zealand is actually around savings and retirement. And we need to be quite courageous about what we're going to do about that. And KiwiSaver plays an important part of it. So encouraging people to save more, I think, is vitally important. But I think also some of the settings we can look at in time. But again, this will be a detailed conversation I'll have with people.
Question from the audience. At the last FSC conference, the message was, let's think about repealing CoFI. Your comments today are a little different to that. What transpired in between?
Well, Robert alluded to it. I've had many meetings with lots of people around CoFI. And obviously people are starting to make applications already to the FMA. So, and more significantly, the large organisations have spent the money, spent the time doing a lot of those applications, and they're going in. So what they said to me is, look, let that process run. And so I accepted that, and I think that's a good idea. What I'm more worried about is the many smaller institutions, and I've met some of you, who haven't yet started it, because you're looking at this thing going, wow, I don't know how big it is. It's got a very costly process, and it's a very expensive from a time perspective. And so what I'm more focused on, the smaller, medium to small financial institutions, and to give you better direction of travel. So you now know, and Sam will talk more about it, but you need to tailor your fair conduct program according to your business. And you have discretion as the management and directors of that business to determine that. And they will be quite different. And we don't want teams, but we want effective programs. And to help that, Sam's obviously from the FMA going to provide some guidance around that. She'll talk more about that. But I think that gives more certainty in terms of getting people on that runway, because everyone does need to make their CoFI application by March next year.
Another really great question here. Your government has a very packed agenda. What's your time frame for your Twin Peaks and conduct licensing regime to kick in for?
So in terms of the process, I'm trying to do both CCCFA and CoFI. We're going to do the regulatory change pretty quickly over the next couple of months or so. And then we'll do the legislative change probably around the middle of this year. In that sort of third quarter, and try and put that all through. So that it's important we do that. And I talked about transitional arrangements. So this is why I'm obviously FMA have a big role to play on this as well. But we'll put in as much as we can as quickly as possible. But what I wanted to do very clearly today is to deal with this issue, because I know many of you are wondering how we're going to play it.
Just changing topics briefly, this relates to FBT on group schemes. Is there any consideration to remove FBT?
Is this an insurance question?
It's an insurance question. It is. Thank you. For employer-funded group schemes, especially for group healthcare, which is one of the impediments to large organisations and small putting in place group schemes for their employees.
Yeah, unfortunately I lost the tax portfolio, but I was speaking to a couple of you earlier on. You'll need to go and see Minister Watts, but look, right now we're, as you imagine, in the government and the turnaround job we've got some really big priorities. There's a new tax bill coming through very shortly around some of the tax changes we talked about during the election. You know, all those big focuses and all of the portfolios, we're just trying to get onto the runway, dealing with those 100-point plan that I talked about. That's the big focus. We're halfway through 100 days, So all those sort of issues, they'll be sort of picked up in time, probably in the next year or so, because there is just such a legislative workload we've got to get through. And the biggest issue I've actually got is how do I actually get enough legislation time in the House to pass some of these things?
Because that is an issue, right? Because
Yeah.
every minister's doing what you're
Yeah.
doing, which is getting your priority list.
Yeah.
How does that give effect when there's competing pieces of change that need to all get on the order book?
You talk to Mr. Bishop and make sure you put up a good case. But also, all ministers have had to do a prioritisation, which we're discussing with the Prime Minister. So those key aspects will be all put into a program. So that also helps with the prioritisation, because each minister's going to make sure that they've got a priority list that they're heading to.
Got time for a couple more questions. This is a pretty forthright and provocative one. It relates to deterrence from the FMA or from the regulators. What's the minister's view on the focus of enforcement by the FMA? Is the investment in the public interest, and does it create a culture of trust in the sector?
So is that just elaborate a little bit more in terms of what, just general inquiries or specific areas?
I think generally. So what's the minister's view on the focus of enforcement by the FMA?
Look, FMA have got a very important role in enforcement, but there's a balancing act, isn't there? There's a need for the FMA to make sure that it provides proper guidance, but it's also got an enforcement role. And I'm not going to talk about specific case or anything like that. It's not my role. But I think that's an issue for the board of the FMA. I'm obviously in contact with the board and Samantha. But we just need to make sure that it is the right balance. And sometimes things might be right, sometimes it's wrong. I've got the same issue with ComCom about their enforcement, because they've also got a large role to play. And you could argue in some ways that the ComCom perhaps hasn't been as active as it might have been. So, regulators all through the time go up and down. Sometimes they do it well, sometimes they don't.
Time for three last questions. The KiwiSaver question. When will KiwiSaver be reviewed? You did point to some in your speech.
It'll probably be something I'll be turning my mind to in the second half of this year. As I say, it's part of that capital mix. I've talked about this before in the meetings here, but I look at the 100 billion that's now in KiwiSaver, and I really want to help the industry take the opportunity, if they so choose, to invest in an alternative asset class, which is supporting great New Zealand established businesses. And there's some restraints around that, which I'm aware of, two in particular. So I'll be working with them. So it's not just about KiwiSaver, but it's also about how we mobilise capital in New Zealand.
Minister, one last question. It always amazes me people who step up into the very public life of public service. You've been in politics a long time. What are you most looking forward to over the next of the term of your government?
Doing stuff.
Fantastic. We will.
I'm looking down here at Andy and Paul. They are the ones that worried. But let's get on. Let's get this sector rocking, eh? It's just been... what I don't like hearing is how you guys sort of feel like you're beared down with all the regulations. Someone came up to me before and said to me, all this compliance cost is just, we work our way through it, but it's not exciting stuff to do. We do need certain rules and regulations, but what I want to do is really get this industry cracking and feel like you want to be part of it. And how do we attract new people into the industry? And I think, that's the objective we should be trying to achieve. And the bits I can do to try and remove some of that cost burden, whatever it is that you feel that you have, to loosen up this sector and make it grow like Billio, that's what I'm really keen to do.
Minister, thank you for the fireside chat. Thank you for your speech. We have a formal vote of thanks for you. But on behalf of all of us here, we certainly wish you well in the term of your over the next 12 months to bring change.
Hopefully
we're supporting
longer than
it. And away we go. Thank you.
Yeah, great session and sense of the direction of travel. And now Lloyd Kavanagh partner Minter Ellison Rudd Watts will give a formal vote of thanks. Welcome, Lloyd.
Tēnā koutou katoa. Actually, I feel quite honoured to be giving this vote of thanks for two reasons. First of all, I've known the Minister for a very long time, since before he went into Parliament, and I hear from family that he's a very good MP for Port Waikato, and before that, Honua. Also, I'm very honoured to give this vote of thanks because Minter Allison Rudd-Watts has been a long-time member of the Financial Services Council, going back even before its formation to, I think it was called ISI, the Insurance Savings and Investment Association. So we're closely associated with this organisation and know how important it is as part of the infrastructure. Turning to the Minister, there are some particular points that I'd like to call out and thank you for acknowledging. First of all, the importance of the financial services sector to New Zealand's economy. I think it often doesn't catch the interest of the media or wider New Zealand that this sector in itself is a major contributor to GDP directly. And secondly, that of course finance is the life and investment is the lifeblood of the rest of the economy. So that's why what the Minister is talking about is so important. I also would thank the Minister for going back to and referring to the work that so many did coming out of the GFC, which resulted in the formation of the FMA, the passing of the Financial Markets Conduct Act, which I think has been a reform which has endured and contributed successfully, and good to hear the Minister acknowledging that in some ways we need to go back to some of those principles. For me, I think it's always worth going back to sections 3 and 4. I'm a lawyer, so I would do that. But looking at what the purposes were, which included explicitly things like efficiency and encouraging innovation, and the importance of businesses as well as consumers and investors. So that was fantastic. Finally, I really want to thank the Minister for leaning into this sector. He's got energy and passion for it. We do understand the coalition government has a whole series of things it wants to address, but I think I could certainly hear that the Minister is putting his energy into this sector. And I guess I just warn him that he's going to continue to get a lot of us engaging and helping him continue the direction of travel that he's outlined at us today.
Thanks, Lloyd. And now it's my great pleasure to welcome to the stage FMA CEO Samantha Barrass for a keynote, followed by a fireside chat and some audience Q&A. Welcome, Samantha.
Enga mana, enga maunga, enga hua wha. Tēnā koutou, tēnā koutou, tēnā koutou katoa. Ko Samantha Barrass taku ingoa, ko taku mahi ki te mana tata e hoko hoko, ko te mana whakahaere. Tēnā koutou, tēnā koutou, tēnā tātou katoa. Well, this is my third FSC Outlook event. There is, as I'm sure you've now realised, much to cover in the next 30 minutes. And before I do that, though, I want to acknowledge the work of everyone at the FSC, including Rob Flanagan. The work of the FSC, from the board to its staff, to members of the FSC whose staff contribute to its committees, this work is incredibly vital in the engagement-led approach that we enjoy with you. The Minister this morning has set out a clear vision and direction for financial services regulation in New Zealand. Based on my experience across multiple jurisdictions, these changes offer the opportunity to streamline and bring New Zealand up to best of class, learning from what has and what hasn't worked in other jurisdictions. I'm going to build on some of the points the Minister has raised, speak to the importance of the Twin Peaks regime working well, and reflect on how a move to outcomes-focused regulation is rooted in the reasons that I became a regulator in the first place and the importance of the work to further develop New Zealand's capital markets. With the start of the year, there's an opportunity to look back as well as forward, and I want to quickly reflect on 2023. It was a year in which the new financial advice regime came into force, our work on CoFI deepened, and our implementation of the climate-related disclosure regime came into effect. I raise these because it shows what can be achieved when the FMA and the industry work closely together. The FMA and the New Zealand financial services sector has at its best always been open, engaged, part of a two-way conversation about how we achieve our objectives to ensure the financial services sector is working well for all New Zealanders. If we keep that in mind and preserve it in the year ahead, I think it's going to serve us really well. The Minister this morning has set out proposals to change how financial services is regulated in New Zealand. The FMA is committed to working with the government to implement these. Our view, as an independent regulator, is that using the core principles at the heart of CoFI can result in a simple and streamlined approach for conduct regulation in New Zealand across the piece. The fair conduct principle that sits at the heart of CoFI is that a financial institution must treat consumers fairly. And there are 5 fundamental components of this fair conduct. The first is paying due regard to a consumer's interests. The second, acting ethically, transparently, and in good faith. The third, assisting customers to make informed decisions. The fourth, ensuring relevant services and associated products meet the requirements and objectives of likely consumers. And finally, not subjecting consumers to unfair pressure or tactics or undue influence. Taking this approach to the conduct of all financial services means that an outcomes-based regime can provide flexibility, support critical innovation, and avoid box ticking. It promotes a supervisory monitoring relationship that facilitates the proactive and proportionate engagement. It also enables us to minimize regulatory burden. On CoFI, we have already been engaging proactively with the industry in a variety of ways. Additional guidance and engagement will be provided for very small firms to ensure that they have everything they need to be successful. It obviously costs more of our resources, but it makes things less costly and more straightforward for firms. And we will be working with both the government and the sector to do this. We have heard feedback from some in the sector who believe the FMA will be subjecting firms' fair conduct programs to significant scrutiny during the licensing process. I want to be clear that this has never been our intention and has never been a part of our planning. It's not for us to go through your fair conduct program line by line. We're not going to be signing them off. The responsibility for these programs sits with the boards of the institutions, and it's for you to right-size your fair conduct program or your CoFI application for your business, and that's particularly important for smaller firms. We will be flexible and respond to different business models throughout the licensing process and in our supervision and monitoring approach. We have never had a one-size-fits-all approach to our work. Instead, we want to take an approach based on engagement and working with the sector. Whenever a funding and levy review of the FMA has taken place in the last few years, the sector has been largely clear that it's this approach of being flexible, engagement-led, that is preferred over a rules-based, enforcement-led approach. Yes, this means greater costs for the FMA that the industry largely pay for, but critically, firms benefit from a more efficient regulatory regime. As you've just heard, the government is considering the best way forward on CCCFA. When New Zealanders talk about their experience of the conduct of financial services, credit is always going to be top of mind. A critical role of financial services is enabling Kiwis' lives. It's their ability to borrow money, whether it's to buy a house or make urgent repairs to their car. We can see sense in having a single overarching conduct regulator. We see the value of using the broader regulatory toolbox provided through the Financial Markets Conduct Act to support appropriate regulation of registered banks, non-bank deposit takers, and high-interest lending by all lenders, particularly those targeted at vulnerable communities. Aligning credit regulation with an outcomes-based approach and fair conduct rules would provide clear and constructive benefits. It would provide regulatory certainty and efficiency. It would help ease burden while ensuring a range of monitoring, supervisory and enforcement tools to manage poor conduct in the sector are very much in play. It would also allow expectations to evolve as new technologies, products and business models emerge. So the FMA is looking forward to engaging constructively with the planned review in the coming months, and we're ready to implement any changes that the government may see fit to make as a result of those. A key message that the industry has regularly given both the FMA but also other regulators and policymakers is the need for greater coordination. We have sought to respond to that through the Council of Financial Regulators, providing clarity through the regulatory initiatives calendar, for example, and seeking to coordinate agency activities. Bilateral engagements have also been significantly strengthened. We are mindful that the industry has been through a period of significant regulatory change in recent years, while also coping with huge external shocks and the impacts of events like COVID-19 and last year's weather events. Noting those events, it's important to recognise that different independent regulators and policymakers will consider risks and events through the lens of their separate regulatory objectives. And regulators have already taken steps to try to manage this while mitigating the burden. Many of you will have experienced the joint calls that the FMA and the RBNZ conducted during these events, and these received positive feedback. My view is that this cooperation and coordination should continue to intensify. It's about continuous improvement, really leaning into it, and only by doing this can we seek to deliver the outcomes that we need to achieve for all New Zealanders and manage the impost on industry. I want to turn now to outcomes-focused regulation. As most of you will know, over the last couple of months, we've been holding sessions in Auckland, Wellington, and last week Christchurch on outcomes-focused regulation. Why have we embarked on this? Why do we think it's important, and what are we hearing from these sessions? The point, and I think this is very relevant to the discussion generally that we're having this morning, is to bring about a shared focus on the so what of our collective effort, yours in the industry and ours as a regulator. The point is to recognise the risk of not seeing the wood for the trees that arises from more prescriptive tick box approaches to regulation. It's a risk I have been concerned about for my entire career in regulation. It's why I left my exciting career as a monetary macroeconomist and moved into regulation in the first place. The risk of tick box regulation is real. It contributes to regulators failing to spot emerging risk, despite the cross-sector vantage point that they have. It increases the extent to which regulation can cut across innovation, including innovation that is going to improve outcomes for consumers, markets, and society. Unfortunately, it allows some to design technical compliance models that fail to achieve the consumer and market aims for the regulatory model. Rules and regulations are, of course, a critical part of the framework. These outcomes don't replace legislation. They are not new rules. We believe strongly that our legislation supports these outcomes. The law also provides the mechanisms, where they're needed, for us to enforce the legal obligations that support the outcomes that we are seeking. We don't need to go back too far to recognise the market failures that have cut across consumer outcomes in clean markets. Just a cursory look at the enforcement action that we have taken in the past year demonstrates the risk posed by those who can't or won't deliver fair outcomes or support clean markets. We made it clear last year that we are alert to any practices by providers that lead to high-pressure sales, not just commissions, not just sales-based remuneration. We acted following a review of the classification of wholesale customers. These are good examples of us beginning to consider how outcomes-focused regulation will work in practice. We weren't simply focused on a narrow range of practices. We were looking at risks to the outcome that consumers can trust providers to act in their interests. But I want to turn to us, because I want to be clear, the FMA's focus in outcomes is in the first instance something for us. It's about our regulatory approach and the judgment that we bring to our work as a regulator. It's about us leaning even further into our engagement-led approach. It's about forward-looking supervisory judgment that is risk-based and outcomes-focused. The consultation is seeking your views on the outcomes that will guide our approach to exercising our regulatory powers and responsibilities. And it will be the risks to these outcomes that first and foremost guide our decision-making on how we use our resources. For our supervisory approach, we will use these outcomes, not detailed compliance requirements, to frame our discussions with and assessment of providers. I've been clear, and we get it, that this is a profound shift for us as an independent regulator, and it will not happen overnight. As a part of our preparation, we will first look to pilot approaches this year with a small number of firms. Participation, I hasten to add, will be entirely voluntary. There will be no arm twisting. If you're interested in helping to inform our approach, let us know. Either grab me later on today or any one of the FMA team over here, or in your responses to the consultation. We know that we need to start by instilling confidence in the approach, and the best way to do that is by demonstrating it to you so you experience it. It's our intention that your engagement with our monitoring teams will begin to see a palpable shift to outcomes rather than rules and compliance with rules. And in so doing, we want to shift the focus to outcomes for consumers and markets and innovation for firms. I'd like to close by reflecting on the importance of the work that we are doing to develop and deepen capital markets in New Zealand. A few years ago, the FMA, alongside the NZX, co-sponsored the Capital Markets 2029 work that considered further ways New Zealand can both enable businesses to attract capital, but also ensure that investors have assets to invest in. It will be important, not just this year, but in the years ahead, to look not just at the regulatory framework, but how we're ensuring New Zealand firms have access to capital to grow, and that the investments are there to ensure KiwiSaver funds have something to invest in to help grow the New Zealand economy. KiwiSaver is now over 100 billion, and it's a significant part of New Zealanders' assets. The FSC's blueprint for growth poses good questions about how the government, the sector and regulators can work together to grow the financial confidence and well-being of New Zealanders, and I commend you for the work. I want to finish on a reprise. The FMA and the New Zealand financial services sector has at its best always been open, engaged, part of a two-way conversation about how we achieve our objectives to ensure the financial sector is working well for all New Zealanders. I'm looking forward to keeping that in mind for 2024, working with you all, and I suspect it's going to serve us well. Thank you for your time. Tēnā koutou, tēnā koutou, tēnā tātou katoa.
Thank you very much for your keynote, Samantha. As you said, certainly there's a lot to cover.
Indeed.
I think it's fair to say. So another new year,
Yes.
and it looks like more changes for FMA, which I'm sure you and everyone else will take in their stride. Tell us, what do you think is the most important thing you heard from the Minister today?
Oh gosh, it's a bit hard to pick. There's quite a lot in there. I think there are two things that I'd like to call out. The first is, what I sort of really taken from the Minister's speech is that shared focus and certainty around delivering fair conduct for New Zealanders. And I think we had some certainty today over the focus on that, the certainty to continue licensing applications and developing the fair conduct program. But I think we heard running alongside that something that is incredibly important, which is the need to look at how do we streamline the requirements? How do we make sure that it's straightforward, and particularly, how can we look to get rid of anything that's just not necessary in that process? And particularly the work, and I've got a team over here who are very well used to and very well experienced with working with all providers, but small providers in particular, the work that we need to and will be doing to provide guidance and to support to small firms in particular, and we're looking forward to doing that. The third element, and this is from a New Zealand, from a New Zealand kind of Inc. perspective, I think was the strong desire to move to quite a clear, clean Twin Peaks outcome for New Zealand, with there being clear certainty on who's responsible for conduct regulation and who's responsible for prudential regulation. And I thought the ideas over the over the single license for conduct are incredibly exciting. We've been working, very positively and constructively with the Minister, his office and MB on this, and we're very much looking forward to continuing that.
Great. So, yeah, certainty and clarity, those are kind of the key
but
things.
Streamlining.
And streamlining,
yes,
that's right.
Making it as straightforward as possible.
Great.
Yes.
And the Minister spoke of a 2-phase review. So there's a possibility that FMA will take on the responsibility of the CCCFA. And is that something that you as FMA want or you were ready for?
Yeah, In my leadership at the FMA, and this is very, very strongly supported by the board and all the staff, we come at those questions not from a what do we want or what's convenient for us, but actually what's right for New Zealand. And there is, we've got the minister's announced a 2-stage approach to CCCFA. The first will be kind of any quick wins that there can be to get that working better. When you look at the minister's announcements today around the longer term review of CCCFA and the Twin Peaks and a single conduct regulator, folding credit regulation into that, because of course it is part of financial conduct, it seems to us to make a lot of sense for the FMA to play its role as a single regulator. And if that is where we end up as a result of the review, then we will step up and play our part.
Excellent. And still sort of thinking about certainty, so the Minister made some comments around CoFI and timing and things like that. From the FMA's perspective, because I'm sure the industry would like that certainty, how does that look?
Well, for us, it kind of looks like, keep on with your licensing applications. The implementation is March next year. Keep on with developing your fair conduct programs. As I said, that's around the work that you do, to look at your business model and work out what's going to be right-sized for you. I just want to really underline the extent to which we will be there to hold your hands along the way. And again, I kind of keep pointing to the team over there. Some of them are incredibly well known to you all, and they're busy. They'll be busy getting ready to support you through the process. Either grab them today if there's a break, or we're always at the end of a phone or an email.
Great. And so we are getting some Slido questions coming in, and we will look to kind of aggregate those as much as we can because we are quite sort of crunched for time. So if we start off with, perhaps if we talk about outcomes-focused regulation, it's obviously something that you're very passionate about. So why don't you give us a bit more on, how it will work and when the industry will see it really coming into effect?
Yeah, so it's really about sort of bringing a number of things together. First of all, it's the bringing together the engagement-led approach, the experience that we have. I mean, if you look at the implementation of the financial advice regime, that was done incredibly smoothly compared to just about every other jurisdiction that type of regime has been brought in before. It's about sort of getting a really strong focus on the so what of our regulatory effort, as I was saying. We really, really do not want it to be something else you have to manage. So when we're consulting on the outcomes, what we're doing is trying to say to you, these are the ways in which we want to look at our regulatory effort. Do you agree? Are there any other outcomes that we need to be looking at, any other lens that you think we need to be looking at? And there's not going to be a big bang with outcome-focused regulation. What I really want, starting with the piloting, is that firms begin to see that the nature of their conversations with us change. We're not there asking them to fill in multiple forms with, have you got this in your board minutes, or can you produce this document? Actually, they feel they're beginning to have conversations about things like, what approach are you taking to testing your new products on your customers? And have you thought about the ways in which your frontline team are engaging with consumers, understanding their experience? So it's more something that will evolve over time, and you'll particularly see it in our supervision and monitoring approach. What you will not get is this will not be another set of rules that you have to fill in forms for. You'll see it coming from us. I plan on it being a pleasant surprise.
And I think specifically in terms of outcomes-focused regulation, there's sort of a couple of questions around maybe the sort of enforcement aspects of that. So one, when you regulate for outcomes and find something you don't think is satisfactory, how does traditional compliance with obligations come into that discussion?
Yeah, so there's, I'm going to actually start from one of the points that I've made throughout my 2 years as Chief Executive. The FMA is not an enforcement-led regulator. We don't start with enforcement, and I think that's quite clear actually in the work. If you compare the work that the FMA does in contrast to perhaps some other more enforcement-led regulators in other jurisdictions, we need to have the powers that we have to be able to act when we see egregious behaviour or we see long-running non-compliance where that has just been ignored or not dealt with for a very long period of time. The outcome, in a way, the outcomes-focused approach is really going to be much more around the way that we do the monitoring and supervision. The enforcement approach that we take, which is very much against the laws of the land, as I said in my speech, they very much underpin the work that we do. This is a way of creating a dialogue and a focus. It's not changing the dial at all.
Yeah. Okay, thank you. And another question that is very popular. So what conduct has the FMA seen? So are there specific examples that is objectively improper but is not able to be prosecuted under the existing FMCA enforcement provisions? And I know that the team are here and they're happy to take questions afterwards. I hope happy isn't overstating it. But
have we seen things that we can't? On the it's a difficult question. I mean, I would start by saying under the FMC Act, the fair dealing powers that we have under that have provided us with a means by which, where there aren't direct requirements, we can, and as you know, we have enforced against those. I think where we're kind of looking for our powers to improve, and CoFI's been an important step forward here, is the problem with enforcement is that you're the ambulance at the bottom of the cliff. So you're there when things have gone wrong. And that's why we're fundamentally not an enforcement-led regulator, because primarily what we want to be doing is to stopping to be stopping things from going wrong in the first place. Enforcement is a very necessary tool. It's there as a credible deterrent. It's there because, frankly, from a firm's perspective, if you're putting all the effort and the thinking into delivering the outcomes that we're looking for, that New Zealand is looking for from the regulation, why should your competitors get away with not doing it properly? You know, it's around kind of a shared view of what's, you know, of the collective effort that we put in to delivering great outcomes and making sure that there's a credible deterrent for those that can't or won't do that.
And we've only got a little time left, but it'd be really good to just touch on, you know, the sort of capital markets and KiwiSaver ideas, and the Minister spoke about those. And for anyone, if your questions have not yet been answered on Slido, please feel free to take them up after the session. So, you know, can you just tell us about how you see those next steps for KiwiSaver?
Yeah, look, this is something where we're very willing to be part of the dialogue. KiwiSaver's been around for a long time. It's a critical part of Kiwis saving for security in their retirement. We do think it's time for a holistic review, and there'll be many who will play an incredibly useful part in that, and we'd like to think that we could contribute.
Thank you so much, Samantha. As always, we really appreciate your openness, the collaboration, your constructive engagement, and your insights. Thank you once again, Samantha.
Thank you.
And we do have something quite exciting now, just before our Chief Economists briefing, which will also be exciting. Let's welcome Tracy Cross and Richard Clippen to the stage for a big announcement. Tracy and Richard, the stage is yours.
Thank you, Vanya. Thank you, Samantha. We wanted to share with you a really big announcement, which we've only just sorted out in the last couple of days. And we're going to welcome Tracy once she clambers over the furniture. So welcome, Tracy.
Thank you, Richard.
It's been a joy and a delight to work with you and the Women's Super Team now for a number of years. But there is a big announcement, and what is it?
Drum roll. Look, I'm really delighted to announce that Women in Super is going to be merging with FSC as we come together to move together stronger, continuing our enhanced focus in relation to the financial confidence and wellbeing of women, while we encourage more women into the financial services industry, supporting them into leadership positions within it. So there's going to be some great sort of announcements made, giving the detail, because it's not all about Women in Super members coming in. The announcements will involve you all, and there's some great inclusive opportunities, and those announcements will be made as we work to our launch, which will be on the 27th of March. So please put that in your diaries, because we've got a fantastic guest from the UK joining us, and what that guest has to share will be relevant and of interest to all of you, men, women, whatever. It's going to be a fabulous night. So we have an exciting year ahead.
Thanks, Tracy. And I think strategically it's a really important signal that the FSC is an umbrella. There are multiple communities now inside the FSC. We coalesce together at big events like this, but we can still work in our own particular markets and communities, and this is going to be a fabulous focus for 2024 and beyond. So, Tracy, more to come on that, and we're going to head back to Vanya. Thank you.
Yeah, there's been a flurry of emails about, the excitement of getting that one in our calendars. And now it's time for our leading economists to tell us how they see things for 2024 and beyond. Mark, Sharon, Calvin, invite you to the stage and take it away.
Well, what an exciting year we've had. It seems to be an exciting year on top of a bunch of exciting years. So I'm looking forward to this conversation. I think before we begin, can you start again by please welcoming Sharon Zollner from ANZ, Mark Lister from Craig's Investment Partners, and Kelvin Davidson from CoreLogic New Zealand. So welcome. Thank you very much for your time.
Thank you.
I'm Mark Benicevic from Partners Life, and my challenge is over the next 40 minutes to try and extract as much great information out of these fantastic minds as I can. So I'm going to start with one opening question, and I'm going to ask the same question from each of you, starting with you, Mark. Can you please reflect on 2023 and then look forward to 2024? What have we seen and what can we expect? How confident are you in your predictions?
Right, well, looking back on last year, I think generally the global economy probably held up better than many people expected across the board. The wheels didn't fall off, and that was contrary to numerous risks and lots of expectations of it being a very difficult one. China was probably the big disappointment. We didn't get that reopening story that we hoped for, and that is still a country, a very important one to New Zealand, that's in a difficult spot. At the other end of the spectrum, you had the US that powered ahead, was very resilient, and still looks much stronger than many others. So that was sort of the economic backdrop, I guess. In terms of investments, which is my wheelhouse, it was a fantastic year. Despite all the nervousness, all the doom and gloom, global shares were up more than 20% last year, which is more than double the long-term average, led by the US, led by Japan. New Zealand a little bit more subdued, but it was generally a pretty positive environment. And I think even here in New Zealand, you had fixed income deliver the best return that we've seen in almost a decade. So a surprisingly positive year despite a difficult backdrop, and the lesson there, I suppose, is that even when there is a long list of things to worry about, which there always is, you still have to take some action or at least sort of hedge your bets. Fast forward to this year, I guess there are some positives. In my opinion, inflation has peaked everywhere and will keep heading down. Interest rates have also peaked pretty much everywhere except Japan, and this will be the year that we do see declines, maybe not as early or in the same magnitude that some are hoping for, but we will see declines. Those are really important tailwinds for the global economy and for investment returns. So I think it is a year where we can still see some strong performances from many asset classes. There's still a lot of risks and a lot of challenges. Will we see a US recession? It's certainly not unavoidable, but there is a reasonable chance that we do see those high interest rates catch up with the world's biggest economy. China's still in a difficult spot, and there's geopolitical risks with the US election, with all the tension you're seeing in the Middle East and so forth. So I feel like we will have a better year than many are expecting, albeit maybe not as strong in places as we saw last year. Although, you touched on the level of confidence, and I feel like I have a low level of confidence in many ways, because there are a lot of things that are up in the air, and a lot might depend how quickly some of the world's central banks, most notably the Federal Reserve, choose to take some action. So I think it's still a year. We're not out of the woods, and it's still a year to sort of be a little bit cautious.
Great, thanks, Mark. Sharon.
Well, last year obviously wasn't easy. We've seen some GDP numbers that show that per capita GDP fell 3% in the year to September last year. So absolutely can't minimise that some people have been doing it really tough. But for businesses, I think the theme for last year was, actually, it's not as bad as we thought it was going to be. The trough of all our business sentiment and activity indicators was in November 2022, when the Reserve Bank basically admitted they were going to deliberately cause a recession and hike the official cash rate 75 points in one hit. That was quite, people were reeling after that. But the theme of last year was, actually, for businesses at least, this isn't as bad as we thought it was going to be. And partly I think that reflects that while the New Zealand economy was horrifically overheated, it wasn't on the back of booming private sector credit. It was booming public sector debt. And so we haven't had that hangover. And you can see it in the likes of mortgage default rates and stuff have been very muted, even though we've had the most insane housing cycle that we've ever seen. So the hangover hasn't been as bad. And so that is genuine good news if we've had enough pain to sort out inflation. And that is not a given. It's not a slam dunk. The next year is the year we find out, has the Reserve Bank done enough? Is it really all over bar the shouting? It's just worth remembering in the cycle that ended 2008, they paused and hiked again twice. So if we do end up in a situation where they come back for another go, it would not be unprecedented. It's not our expectation. Inflation is falling. Is it falling fast enough? Obviously global inflation could turn around and deal us another blow, while that baseline inflation, domestic inflation, is still pretty high. That's the concern. Shipping costs are spiking again. Oil prices, fine for now, but obviously the risks are hard to miss. So I think, 2024, no, don't trust anyone's forecast about, I would say, about this year. Be nimble, because we are still, it's a nuanced situation. We've made good progress on inflation, but we're not there yet. Central banks are still nervous, and obviously the global environment could throw some curveballs. But so far so good. We'll end on a positive note. Yeah.
We're in January, yes. Thanks, Sharon. Kelvin, you'll kick off.
Yeah, thanks. So my lens is property, so I pretty much talk about the housing market. I mean, everyone lives somewhere, so we all kind of know what happened last year. We called it a year or two halves. First half of the year was obviously pretty quiet for house sales. In fact, like a 40-year low for house sales. And house prices still falling a bit more. Get into the second half of the year, some of those things turned around. Migration's obviously very high. Mortgage rates stopped increasing. What else? We had LVRs and CCCFA loosened. So started to see signs of that turning around. Now, it's continuing. I mean, it's a bit patchy from month to month, region to region, but at least it's continuing. So I think that's the sort of environment we're in for 2024, more sort of housing market recovery. I mean, the New Zealand economy has been called a housing market with some other bits and pieces, so it's pretty important. I suppose for me, there's lots of themes, but I'd pick out maybe three things. One is regulation. We've heard CCCFA talked about, we know LVR is going to be loosened. I mean, it's consultation, but it's going to happen, you would say. And what else? DTI is coming in. Now, net effect of all that on the property market, probably upwards, because DTIs aren't going to do much straight away. LVR's loosened. They're especially binding at the moment for investors. And we've seen how investors react historically when LVRs are loosened. So I think that could be not saying it's a big thing, because there's other restraints on investors, but at least some kind of boost. And it sounds like CCCFA is going to be a boost as well. So regulation, probably net positive. How first home buyers and investors kind of react in that environment. First home buyers have been pretty strong. may not always have it their way. If things are turning a little bit more towards investors' favour, or that we could see their market share rise back again. And then within all of that, you've still got mortgage repricing. Everybody's starting to talk now about maybe some OCR cuts, but we've actually still got effectively monetary policy tightening to come, because I know I'm still on a fixed rate from a couple of years ago. I've got to get up to maybe 7% still, and there's a lot of people out there in that boat. So yep, regulation, different buyer groups, and that repricing is, I think, still something to watch for 6 months. Getting into the second half of the year, we might be through the worst of it. So overall a kind of subdued year, but recovery continuing.
What do the stats tell us about what portion of New Zealanders are still coming off their fixed rates?
Yeah, so we don't know from the Reserve Bank stats when people took out their loans, so that makes it a bit hard to quantify like the interest rate change they might be looking at. But we know right now, if you look at it by value of mortgages, there's about 55% currently fixed and due to see a rate repricing in the next 12 months. And it's pretty evenly spaced out across that year, so it's kind of, 27% in the first 6 months and 27% the second 6 months. So yeah, there's a lot. Now, we don't know what the interest rate change is. The kind of best guess is you look at the average rate across the stock of fixed loans, which is sort of 5.5%. Look at market rates. Who knows where they'll be in the second half of the year? But right now, if you're saying, let's say it's 7-ish, then there's another 1.5% to go. So pretty substantial. So it's definitely a theme to watch for sure.
So potentially up to half of the mortgage stock could be coming off refixed within this next 12 months. Some of them may be on short-term fix that have already felt the pain a little bit, but a huge portion of it's still to come.
Yep. Yeah, and people will have had one or two repricings already. And this is always going on. I mean, it's nothing new. There's always 40-50% on a sort of 12-month rolling horizon, but it's not always facing a 1.5% interest rate increase. So I think that's the thing there. As Sharon said, we're just not seeing mortgagee sales. I think in the last quarter there was like 20 mortgagee sales across the whole country. After the GFC, that was like 800 in a quarter. So mortgagee sales aren't there. Non-performing loans are basically nothing. Labour market's been massive in supporting that. People have had work, so not easy, but they'll make it work. So I mean, I'm pretty optimistic that we'll get through that. It's been pretty good so far. And people should be aware at least that their rate repricing is coming up. But I think, a lot hinges on the labour market. There's some risks out there in terms of some job losses. So, for me, that's a big thing to keep watching, and it kind of reinforces this whole, patchiness. And I mean, I didn't answer the question about how confident I am. I mean, I'm probably the same, you never be too confident. But there's some good reasons to think that we'll see that upturn continue, but with caution.
Great. Okay, thank you, Sharon. Just to follow on from that point about the debt to income ratios, the Reserve Bank, I think, was suggesting about 6 times income, gross income. What are your thoughts on the impact that may have on the mortgage and housing market?
Right now, very little, and that is by their nature and by design. Essentially, they will kick in when the house prices, when interest rates are low, and so then the constraint becomes the multiple of your income. At the moment, when interest rates are high, it's servicing the debt is the constraints. You cannot borrow at a debt to income limit that's above that level anyway, typically. They're unlike the LVRs, which are likely to be tweaked pretty constantly. The debt to income limits are more of the set and forget variety. Of course, we can't go back and say, if only we'd had these in 2021, the world would have been different, because, I mean, the LVR restrictions were suspended for 12 months, and then there was a real scramble to get them back on. So we don't know what would have happened had we had these. But there was certainly a significant proportion of lending at that time was at the rates above where these guardrails are being set now. It's basically designed for the sort of scenario where the Reserve Bank feels the need to keep interest rates very, very low, but nonetheless is worried about the quality, the quantity of riskier lending that is going on. Important to note, they're not monetary policy tools, but in most circumstances you would imagine that kind of scenario could be a sort of inflationary environment anyway. Overall, there's a lot of overlap between the debt to income limits and the LVR limits. It's a bit more nuance, but probably it's not designed to be a game changer. It's not designed to have a big impact on credit availability on average over the cycle, and we don't expect it to.
It would be interesting to know how many Aucklanders could afford a house at 6 times their income.
Well, some countries, they set the limit a lot lower. Yes. I was talking to someone in Norway and they said, our limit is 5. And I thought, you impose that on the New Zealand market, you would certainly have an impact on the house prices.
I just want to go a bit global again now. We've had a really turbulent, well, I can't remember the last non-turbulent year we had. We had, Trump elected, then we had COVID-19. We've had Ukraine's now in the second year of its war. We've got Syria. There's news about Syria just coming through again this morning, and Iran. We've got tensions between China and Taiwan. What is the likelihood that there'll be another geopolitical event this year? And have you got any thoughts on potentially what that may be, given that you're quite close to that kind of media? So, Mark, if I can start with you, and other two, feel free to pipe in.
Yeah, well, I think you're right. You look back through history and there's just a long list of events like that. You could add in Brexit, you can add in sort of, the issues with Greece and all the refinancing. And I think the lesson there is there's always something going on, usually a multiple number of things. You could have had me up here on this stage every January for the last 20 years, and every single year I would have been able to give you a long list of what could go wrongs. And yet 17 out of those 20 years would have been actually quite good from an investment perspective at least. So there's always something to worry about, and if you get too hung up on all the what could go wrongs and do nothing, you will get left behind. So unfortunately, I think we often do have to fight against that natural human bias to get wrapped up in all the negative and still, have a foot in each camp. And this year is no different, whether it's the US election and it's headed for Biden versus Trump, and Biden's approval ratings are terrible, and if the US has a recession, then Trump's absolutely in the box seat. So, that's a possibility. What would that mean for trade tensions and all the rest of it? We know how it played out last time. This time it'd be a second and final term. So, this would be the unconstrained Trump, which is quite scary, isn't it? The Middle East, obviously you're seeing sort of those three key trade routes, the Suez Canal, the Strait of Hormuz, the other one that I always forget the name of. That's 20% of global shipping or something like that. So there's risks everywhere. The Taiwanese election, you've got another pro-independence party having been elected, so the tensions are still there between China and Taiwan. So the list goes on, and I think the likelihood of further geopolitical risk or tension is high, if not sort of close to 100%, because there'll always be something. And in little old New Zealand, there's not much we can do about that. We can take action to best mitigate some of those risks and offset them, either as investors or as businesses or as a nation. But you've just got to work with them, because I think we are in a world where those tensions are going to be more elevated from here on.
Great, thank you. Thoughts from Sharon?
Yeah, well, coming back to an inflation lens again, things like the increased focus on economic security, reshoring, onshoring, friendshoring, that sort of thing is reducing the ability or the desire of firms and governments to go for the least cost. So it's a form of insurance, and it has a premium attached to it. That's inflationary. Also climate change, whether you're adapting to it or mitigating it, the same thing. It's inflationary either way. The storms that we're seeing and the repair bill for that, plus the building resilience into everything. Those of course are global things. So it was interesting to hear the Chief Economist from the Reserve Bank yesterday comment that you can spot deflationary things too. Obviously, China is looking at risk of getting stuck in a deflationary problem like Japan before it. So it's not all one-way traffic. But the list of potential inflationary problems for the globe is longer. If that's going to be the case, is it the case that you need to then screw down your domestic inflation lower in order to achieve the same inflation target? Or do you want to start thinking about what the inflation target should be? Is that the thin end of the wedge of the beginning of the end of inflation targeting? All of these sorts of really quite big picture issues I would expect to come more to the fore as these things unfold.
Mm-hmm. Thank you. Kelvin?
Yeah, not a lot to add. I mean, I'm a pretty domestically focused kind of guy, so I won't sort of rabbit on. It would end up subjective thoughts on stuff. But I guess, a couple of things, like Mark said, there's always risks. So, I mean, you just got to get on with it. It's just the natural state. And also, economies tend to grow. You tend to have a bit of inflation. This is the natural state. So within that, you just got to get on with it. And we focus, say, on rising unemployment. I don't know, it goes from whatever it is now, 4%ish. Let's say it goes to 5%. Everybody sort of frets. but that still means 95% of people have got a job. So yeah, I just think, there's I mean, I'm an economist. I tend to have a sort of pessimistic slant, but yeah, you lose sight of the optimistic side of things sometimes, and actually there's always risks. Most people will keep their jobs. The economy tends to grow, so get on with it.
A quick fire question. I'm going to ask you, Mark, but ask you first, Kelvin, because you're New Zealand focused and it's an international question. Out of 10, chance that Trump becomes president in November?
Oh, jeez. I mean, I can't believe that's the two candidates sort of. But I don't know, like 7.
7, Sharon?
Yeah, I'm thinking 7 or 8. It's looking likely.
Oh, look, I'm a bit more optimistic than that. I think if the US avoids recession, then Biden will probably keep his job. You look back through history, it's actually quite hard and quite rare to displace a sitting president. So for me, it comes down to what does the economic outlook look like. And I am a natural optimist, so I would say if the Fed doesn't muck around for too long and they get on with easing interest rates, as they should, because they're almost bang on their inflation targets, if they do that sooner rather than later and avert an unnecessary recession, then Biden will be re-elected. If they screw it up, then yeah, absolutely Trump is a possibility. But 7, geez.
So I'd put you down for a 3 then, Mark.
Oh, not that low.
That low?
Yeah, look, I think it's pretty close, but
50-50?
I'll give Biden sort of the slide edge. Call it 55-45.
Okay, a question from the floor here. New Zealand dollar. Where do we think that's going to be over the next 12 months, and what impact is that going to have on things like tourism? Sharon, can I start with that?
Okay. Well, yeah, there's different forces. China's struggling, obviously, at the moment. They're our largest trading partner. How their consumers are going has a huge impact on our commodity prices. So the New Zealand dollar's actually been doing a pretty good job of doing the one thing it should or can do best, which is follow dairy prices and share the joy and the pain of whatever's going on there around the rest of the economy. So, yeah, the short answer is watch milk prices. But we do have this shadow hanging over us in the form of our current account deficit. So essentially, even though it was the public sector rather than the private sector that went on a borrowing binge, we have not been paying our way in the world, and obviously the loss of tourism for quite a long period didn't help that. So things are coming right, and part of that mix is a drop in consumption and investment, and therefore a drop in imports. Getting there, but not quickly, and we could get a ratings downgrade, and you'd expect that to give the New Zealand dollar a bit of a smack, hasten up the adjustment, but a harder landing potentially as things feed through than we're hoping for. Our forecasts are that it's not going anywhere fast, but it does tend to be quite correlated with global risk aversion. So if everyone's feeling relaxed, then they'll take a punt on New Zealand. If they're feeling nervous, they tend to bring their money home, and New Zealand's not home for much of the world's capital, so we tend to be the loser in that scenario.
Right. Thanks, Sharon. Mark?
Yeah, I think barring the global recession or some major risk event, which would then overwhelm all other factors, that would obviously lead to a fall in currency. But putting that to one side, if you don't get that, I could actually see the Kiwi dollar remaining strong and pushing a little bit higher, because I just look at what's happening on the inflation and the interest rate front, and in the US, inflation's in the 2s, in Europe it's in the 2s. Those central banks look much more likely to start easing policy sooner than us. We've still got that sticky domestic inflation. I know Sharon's forecasts and expectations are for, rate cuts later rather than sooner. So I could see some of those others moving earlier than us, and us being a little bit stubborn because we've got those inflation pressures. And if migration sticks around, growth probably, muddles through as well. So against that backdrop, I could actually see the Kiwi dollar maybe rising a little bit through this year.
Okay, thanks, Mark. Kelvin, any thoughts on this?
Not a lot to add. Like I say, it's kind of external thing. But I just say, I suppose the group who would say, we want a weaker dollar would be farmers. That would be the main thing. And I'm off the farm, so I kind of get it. But at the same time, input costs have been a big problem, and a stronger dollar will help with those input costs. So, it's a two-sided thing. There's never a black and white scenario. So keep both sides of the equation in mind.
Okay, and if I could bring us back to inflation for a bit now, because you talked about inflation being a little bit sticky. There was a bit of a surprise downward in overall inflation, but non-tradables is higher than expected, particularly excluding housing. So what is driving that stickiness of non-tradable inflation? Is much of it caused by the terrible weather that we had last year that was driving food price inflation up? Or what's driving that non-tradable inflation remaining high, and what can bring it down?
Insurance costs part of it.
Ooh.
It's true.
Yeah.
And there's not much the Reserve Bank can do about that either. Sorry, Kim.
Yeah, no, I was just going to say, I mean, you talked about excluding housing, but, I'd add in the housing that we're seeing, big pressure on rents, especially in Auckland. I think on the latest numbers, you're kind of talking 9-10% rental growth in Auckland. Hard to know exactly why, but, at least prove it with stats, but we know immigration's going to be coming into Auckland. Council rates, that's a big part of it. Construction costs are still rising, but not as quickly, but they're still a contributor as well. So outside housing, I'm not too sure. I mean, it's just that general pressure, I guess, going back with, the government debt ramped up and, maybe there's too much money sloshing around. We've still got that domestic pressure. So, yeah.
Sharon?
The IMF estimated that New Zealand was the most overheated advanced economy in the world in 2022. 2023 as well, for that matter, but they might get different numbers because of the GDP revisions if they reran that analysis. But clearly, our economy was very, very overheated with a policy mistake, and in hindsight, it's a wonderful thing, from both monetary and fiscal policy, and also the supply shock of the closed border and the inability to bring in workers was massive. We had the tightest labour market we've ever seen. We have let in 250,000 permanent and long-term, that's an astonishing number, in the last 12 months. Half that many have also gone out. So massive, massive churn, which does kind of grease the wheels of some of that inflation that Calvin was talking about in the housing market, for example. But it also takes a lot of inflation pressure out of the labour market. So our working assumption is that the labour market is no longer inflationary, and that should start to feed through. And so by the Q3 on our forecast, we've got unemployment through 5%, still rising. We've got inflation back in the band, and therefore the Reserve Bank feels comfortable cutting. But there are, as Mark mentioned, some sticky things the Reserve Bank can't do much about. And again, it comes back to that debate of, is it worth it? I would expect that debate to get louder as inflation gets closer to, firstly the target band, and secondly the midpoint. How much is it worth squeezing that lemon to get that last little bit out? That debate lies ahead of us, and some of that debate will centre on the question of, which prices are still going up fast, and is that really the Reserve Bank's responsibility? They can't do anything about insurance costs, so should they hit something else harder to make up for it or not? And if they don't, then what does that mean? I mean, these aren't new questions, but I think they're going to be more discussed this year.
Mm-hmm. On that point of insurance, and fire in general in particular, there's a question from the floor here that NZIER yesterday called for hazard information to be open to all so that everyone can assess risk to property. What are your thoughts on that? Sharon, if I can start with you and then come to Kelvin, and then I'll have the next question for you, Mark.
I'd just say every buyer wants to know about the hazards, but sellers throw a fit if you try and put it on their limb. So, it's it's a fairly fraught question, I would say. You got any thoughts on this one, Mike?
I'm sure Calvin's got some more considered thoughts than me.
I mean, more information is good in my view, and I know I work at CoreLogic, this is kind of our thing. I know it's happening behind the scenes. I know from the Reserve Bank publications there's more emphasis on the impacts of climate change, especially on property ownership near the coast, near rivers, this sort of thing. So I can say it's definitely going on, and it's going to become a bigger issue for sure. So, like I say, data, information, more of it the better.
Yes, and the Auckland rainfall chart last year was astounding, right? If anyone was following that, if you Google it, 2023 relative to the last 65 years was just mind-blowingly out of the water. So we certainly have had some significant change. It's just as well as no climate change. In terms, Mark, of market events, last year it was really probably only 12 months ago that suddenly ChatGPT really exploded, right? And the Magnificent Seven, the largest 7 stocks in the S&P 500, which make up over a quarter of that market, were the best performing stocks. I don't know whether anybody would have predicted that, but what are your thoughts for asset class movements this year? Where do you think that?
Yeah, that's an interesting one. Look at my watch because I know Google and Microsoft are reporting in about 20 minutes, so we'll see if sort of they meet the bar. But the US is really interesting, and I mentioned two super strong markets right at the beginning. Japan up almost 30% last year, the US up almost 30%. But the big difference there was in Japan it was a broad rally with everything going up, and in the US it was a super concentrated rally. You know, those three sectors where the Magnificent Seven live, which is tech, communication services, and consumer discretionary, because they consider Amazon consumer discretionary. Those three just went through the roof, and the other 8 sectors of the US share market, I had a look at this yesterday, the other 8 sectors, so that's sort of financials and real estate and healthcare and all of them, have only risen by an average of 3% since the beginning of last year. So they've done absolutely zip. So I think it tells you two things as an investor. One, you can't ignore sort of those superstar sectors, even though they do look pretty expensive on some measures. So you sort of got to have a foot in that camp, because if you didn't have those, you got left behind. And I think the second point is when we look at, you know, the S&P 500 in the US, it's at an all-time high. Well, is it? It's only at an all-time high because of that small group that's risen. And there's, you know, the other 493 stocks, a lot of them are actually trading at quite modest levels, which is good from an investment perspective, because no one likes buying things at all-time highs. We like looking for opportunities. So a really interesting dynamic.
And what are your feelings on the correlation between bond and shares over the next 12 months? Because it's been a bit chaotic the last few years. Right?
Well, I think they'll be quite well correlated. You know, when interest rates went to zero and you had money printing everywhere, that pumped up asset price across the board. So whether it's houses, whether it's bonds, whether it's shares, whether it's classic cars, whether it's antiques, pumps up the value in everything. And then as you get that reined in, that sees values come back down to earth. So now that you have largely seen interest rates come back up to, you know, arguably sort of the top or roughly where they should be, I think that if you are hopeful of interest rate declines, then you will probably see fixed income assets and shares sort of lifted at the same time, unless interest rates come down because we have a recession. And that's the big debate. And I think that is probably one reason, if you were to sort of overlay, you know, a risk adjustment or a probability sort of matrix over those two asset classes, you might be a little bit more positive on the more conservative ones, the fixed income ones, because they could do well under interest rates falling for the right reasons, but they could also do well if interest rates fall for the wrong reasons, which is that, you know, we wind up in a more difficult economic spot.
Indeed. Okay, thank you. We've got a couple of minutes left, so if I can ask you all a final question and ask you, we've got about just under a minute for each of you. We're going to sit down for Outlook 2025, 12 months from now. This is going to tie back to one of your first comments, Sharon, about the uncertainty of comments. How accurate do you think today's predictions have been? Your predictions for today? What's the thing you're most confident about, and what's the thing you're least confident about? Kelvin?
Yeah, I mean, it's probably relatively safe. I'm pretty confident about that regulatory thing in the housing market. I mean, you know, the consultation's open on LVRs, DTIs, it's going to happen. I mean, I don't think there's been any consultation that hasn't happened. So pretty confident about that. Like I say, a net impact on the property market, probably upwards. And least confident, yeah, I don't know, I guess maybe mortgage rates. I mean, who knows? It's dependent on the official cash rate. You know, do we have inflation under control? Offshore factors as well feeding into those longer term fixed rates. So yeah, I mean, I'm pretty cautious, so I'm thinking, yeah, maybe mortgage rates drifting down second half of the year, but sort of plan for the worst, hope for the best thing. So yeah, and those two things probably offset each other a bit.
Thank you, Kelvin. Mark?
I am confident that this time next year inflation will be lower and that interest rates will be lower. I'm less confident about whether that will come at the cost of an economic mishap, and I'm not confident about trying to predict some of those geopolitical outcomes, because I think they are just really unpredictable. Indeed. And it feels like there's more of them out there at the moment.
Absolutely. Thanks, Mark. Sharon, final word.
Yeah, I'm like Kelvin, probably most positive, confident that house prices will be higher at the end of the year, even though they're currently falling. It's a bit of a strange one, but you can't let in 250,000 people into your economy and not see house prices lift. Even if the world turned to custard, these people have often come from poorer countries and they're here, come hell or high water if they can stay. So I wouldn't expect all those people to suddenly disappear. And interest rates, they could still go higher, but surely not much. So I think probably migration will win that one, though our forecasts are for only modest increases. What I'm least confident about, probably the timing of OCR cuts, even though that's my bread and butter of my job. We've got August in there, but you can imagine those sort of unpleasant scenarios you're talking about where they end up with cuts earlier, but you can also imagine scenarios where inflation gets stuck. We haven't had enough of the medicine, and then they could even go higher again, or at the least could end up being held high for longer than anyone's expecting currently.
Yeah, you shouldn't be too ambitious when the inflation rates are still well outside the target range, right? All it leaves for me to do is to say a big thank you to Sharon, to Mark, and to Kelvin. So if you can give them a big round of applause, please. Thank you.
Great discussion. Thank you very much to you all. Really covering the spectrum from positivity and the power of optimism to unconstrained Trump. So in a moment, Richard is going to close this session with some summary comments. If we could just ask everyone, when you leave, please hand back your lanyards in the interest of sustainability. So welcome back, Richard.
Thank you, Vanya, and thank you, folks. Thank you for your attention and thank you for staying, noting that we had such an awesome lineup, so we pushed the envelope a little on time. 3 things to say farewell on. Number 1, hope you got value out of today. I think the Minister, the FMA, and the Chief Economist came with something to say to set the scene for the year. And I think they've provoked and they've stimulated and they've actually set us in the right direction. So big thank you there. Thank you for taking the time coming out on such a stunning morning. We do have one little announcement we wanted to make, and we'll just go to the slide now. The FSC conference, the famous and fabulous FSC conference, is on in September on the 3rd, 4th and 5th. We've just launched it. There's a special offer which we are going to make to all participants in Outlook, which is the next slide. And we'll send this to you on an email. But suffice to say, it's last year's early bird prices today in 2024. We're already planning. The committee met last week. The brand of the conference is looking fantastic. And a little like today and a little like last year's conference, it's always what can we take and do it better, bigger and more stimulating. So with that in mind, have a really awesome start to your year. I hope you have a safe and productive start to your year. And with that from us in the FSC, it's a big thank you. For those of you here for the FAP roundtable, give us 10 minutes, folks. We're going to be in the Topaz room, which is just at the back there. And we have a really engaged session to follow. So with that, we'll cue the music. There's still some food if you want to stick around and have a chat. But for now, thanks. Kia ora.